Hi, my name is Jordan Wilson. I wanted to take a short pause in this investment series and just kind of do a quick review of where we've come from, the concepts, the issues that we've discussed, because I think they set the table for the way forward. And the way forward is actually investing, building your portfolio, how to maintain it, how to review and rebalance. But I think without the foundation of the core concepts and understanding those, it makes it a little bit more difficult to move ahead with a portfolio side of it. So that's kind of what I want to cover today, just in brief. So the core concepts that we covered, one of the first was investment risk, or risk in general. We looked at pure risk versus investment risk. Systematic, which is the hurricane hitting the entire island, or the economy going down, or interest rates and inflation rising. So widespread impact. And there's not much you can do on a personal level to protect yourself against increasing interest rates or the hurricane coming through and flattening your condo in Cayman. Non-systematic risks were specific to the company or the investment or yourself. And those would be more, how do I run my business? Do I have effective managers in places? Do I have Warren Buffett at the helm, or do I have Ken Lay of Enron fame? So that's the difference, systematic, non-systematic. A big problem with risk is that it's kind of nebulous. You know what it is, but how do we use it in analysis? And that's where standard deviation comes in. It tries to quantify your investment risk. And that's great because it helps with an apples to apples comparison of investments. If I have two oil company stocks, maybe they're similar companies so I can compare them. But how do I compare Chevron with a Government of Canada 30-year bond? And that's again where the standard deviation, it puts things sort of on a level playing field for comparisons. We looked at returns, a variety including nominal versus expected, and the difference between nominal or actual and expected is part of the standard deviation issue. How far do the actual results differ from your expected results? The greater the variance, the greater the standard deviation, the greater the investment risk. We looked at things like mean versus median returns, how geometric and dollar-weighted returns try to address some of the shortcomings in arithmetic mean calculations. We also looked a bit at risk-adjusted returns, Sharpe ratio, Sortino. And again, that sort of tries to get that apples to apples comparison. If I go in and want a car loan or a mortgage for a new house, they want to assess my risk, the ability to repay the debt and make the recurring mortgage payments with the interest. And how risky I am reflects the interest rate that I pay. And that's kind of the risk-adjusted returns from the bank side. The greater the risk that I am, the more I'll have to pay. And again, that kind of gets just at the general risk-return relationship, whether it's investing or life in general, is that investors are quite rational in the sense that if you have two assets, investors will always choose the one with the higher return if they have the same risk. And if you have two assets that offer the same return, investors will always choose the asset with the lower risk. So you always want to try to be efficient on a risk-adjusted basis. And that applies whether you're lending money to your brother-in-law, you're getting a house mortgage from your bank. It's all sort of on a apples to apples risk-adjusted basis. Another core concept that's exceptionally important is diversification. Investopedia talks about portfolio diversification involving a wide variety of investments in your portfolio. And we discussed what the heck is wide. Is that 5 investments, 50 investments, 500 investments? What's the right number of investments? And what the heck is variety? Is that just stocks and bonds? Or do I need to go out and get Bitcoin? Do I need to get commodities? Do I need to find a fine art fund to throw in? And that's kind of where we moved into the asset correlation discussion on how variety is more about dissimilar investments. And we talked about the correlation being between -1 and +1. If something is perfectly correlated to another asset, they'll move in lockstep. If something's -1, it's perfectly negatively correlated. So when one rises, the other one will fall. And by using asset correlations in your analysis, you can manage your investment risk. Because investment return is all just a weighted average calculation. If I have two assets, one 20% expected return, one 10%, and I combine them in a portfolio 50-50, my average weighted return for that portfolio will be 15%. Now, if they were perfectly correlated at 1.0 on the risk side, and their risk was also 20 and 10, then yes, the combined risk would be 15. But very few assets are perfectly correlated. A lot of them tend to sort of be about 70-80%, but there's a lot that at times are quite low. And this is sort of why your financial advisor or someone will say, you know, you should put some fixed income, some bonds in your portfolio. And you're like, oh, that's very low return. Why would I want that? Well, because at the moment, bonds have a very low to slightly negative correlation with equities. So you're hedging, you're protecting yourself a bit and managing your risk by adding the relatively low return bonds in with the higher return equities. And then the final core concept on this slide is compound returns. Again, another crucial concept to understand in your own investing patterns. We looked at the interrelationship between investment time horizon, risk, and return. The less time you have available, you can really only do a few things. You can increase your risk, and by doing so, you'll try to attract higher returns. and or you could increase your funding. But you can't do much about time as it slips away. So the only thing you can do is take on more risk to try for higher returns or increase your funding to meet your goals. And that's sort of an argument for starting earlier. Keep yourself the most flexible, because at some point you're going to have to take on investments with like 80% risk just because you waited until the last minute to start getting serious about meeting that goal. Or conversely, you're going to have to find 20 grand a year to invest, which you probably won't have. We saw that with compound returns, over a longer time horizon, it's actually less about what you contribute of your own capital to the portfolio. It's more about income earned on previous income earned. And that's the compounding. You let the money stay and grow on your behalf. And because of that, you really want to focus on minimizing costs. Why pay tax and let the government accrue the gains from your income? Why let the mutual fund company or your financial advisor reap the benefits of that compound return in their own accounts when you can keep it in yours? And then we looked at the ant and the grasshopper. And that was an excellent comparison of starting early versus starting late. And how if you just invested from 25 to 40, 15 years at a relatively low amount, by the time you retired, you ended up with a substantial amount of money. And the grasshopper, who waited until 40 to start, ended up having to put in a whole lot more of his own money just to catch up, because again, that lack of time caused chasing more risk or additional funding. So again, risk return, diversification and asset correlations, compound returns. If you understand those concepts well, then the investing part becomes quite simple. After that, we kind of looked at unique portfolio, investor profiles, how you as an investor are unique and shouldn't probably take a cookie cutter approach, like taking your age subtracted from 100 and that's your equity mix, or a standard 60-40 equity fixed income split. You need to understand who you are as an investor. What are your finances? What are your prospects for finances, for increasing your income, your revenue stream from employment or business? What phase in the life cycle are you in? Did you come out of high school, apprentice as a plumber, and are actually making good money in your early 20s? Or did you go to med school and maybe you're not actually beginning to earn income until your early 30s? So again, you want to look more at your life cycle and the future than just your age. What are your financial objectives? What sort of constraints do you have in your life that will impact your ability to invest? And again, if you look at your own family or friends, how many of them have the same financial situation at the same age or the same objectives? Maybe I'm 30 years old, single, in a decent job. Maybe I decided to get married and have 2 children by the time I'm 30 and I've got a house mortgage. So again, you can't just take a cookie cutter approach, and that's the purpose of the investor profile. We also look at your risk tolerance because people have different risk tolerances. Some are more risk seekers. They want the higher volatility investments. Others prefer more stability. And then again, with the objectives that you have, you got to look at your time horizon because that affects your investing patterns. The longer the time frame that you have to reach an objective, the more volatility risk that you can assume in a portfolio or an investment. And that means a higher expected return. The closer that an objective is from a time perspective, the more you want certainty. So you'll sacrifice return for lower risk, stability, liquidity. So I think this is an area of the investor profiles that people often just skip right over and get to the investing phase. And that's, to me, a big mistake. And if you work with me, I actually probably spend more time developing your investor profile than worrying about the actual investments that go into your portfolio. We also then had a look at the classic passive versus active management debate. What is passive investing? What is active investing? Do active asset managers achieve alpha? That is, do they generate returns in their portfolios that outperform the benchmark indexes? You would think they do because they are investment experts and that's what they do full time. But as we saw, on a consistent long-term basis, the answer tends to be no. And we looked at why that was the case. We also looked at niche areas or areas that maybe you could exploit if you have some expertise as far as active investing. But overall, I think that I made the case that for the most part, passive investing is probably the way to go. And then we looked at some of the keys to passive investing. Cost minimization, trying to minimize the tracking errors so that you best match the market return, because that's the goal. You're not trying to beat the market, so you want to make certain that you're as close to the market return as possible. We talked as well about target asset allocation, because the asset allocation is one of the big drivers of investment success, at least as far as the variability of returns in a portfolio. So you want to make sure your target asset allocation is correct. And it needs to perfectly reflect your investor profile. And because your investor profile is going to be unique based on your life and your needs, then so too, for the most part, your target asset allocation should reflect that. We went through some of the core asset classes: cash, cash equivalents, fixed income, bonds, preferred shares, and equities. And we saw that equities can be mega large cap stocks. They can be micro, nano, tiny stocks. They can be domestic. If you're Canadian, that would be the Canadian equity market. If you're American, the US equity market. They can be international or global. They can be emerging markets or even less developed, the frontier markets. You can look at equities that specialize in market sectors, consumer staples, natural resources. So there's a whole bunch of different asset classes and subclasses within them. And then we kind of finished up our look at the first phase with different possible investment types. Should you buy individual assets like stocks, bonds, Amazon, Facebook, 30-year US government bonds, term deposit at your local bank? Or should you consider more investment funds, mutual funds, whether they be open-end or closed? Possibly exchange-traded funds. And we saw the pros and cons of each of those. And I think by the end, hopefully, because most people listening to this won't have multiple millions, so they can create a well-diversified portfolio with individual assets. I think we saw that mutual funds and exchange-traded funds are probably the cost-effective way to create a well-diversified investment portfolio. So that's kind of where we've been. We've looked at some of the core concepts. We've looked at investor profiles, the passive versus active debate, target asset allocations, and it's kind of what do we want to put into that target asset allocation. In the next phase, it's time to invest. And even though this is only just one slide, there'll be a lot that we cover here. We'll cover portfolio construction. And kind of the big issues there is the lump sum versus dollar cost averaging debate. How should you build your portfolio? We've decided on an ETF or a mutual fund. How do we actually start buying that for our investment funds? Once we've built the portfolio, how do we maintain it? Do we buy a S&P 500 ETF index fund and hold it forever? That would be the buy and hold strategy. Or do we look at that and say, you know, the markets are pretty strong today and the expectations are there's going to be a correction. Maybe we should cash out right now and take our profits. And then when it falls, we should jump back in. That's another approach. How do we assess the performance of our portfolio? That's the review process. What sort of comparisons should we make? Are we happy with anything over 0% return? Probably not. Do we want to outpace inflation? Yes, but is that good enough? So what sort of things should we use as benchmarks to review our portfolio performance and assess the areas that we should take remedial actions on to improve? How often do we need to review a portfolio? What is the periodicity of it? Do we need to review that portfolio every month? Every 6 months? Every year? Every 5 years? The answer actually for that could be yes to any of that. It depends on the type of portfolio that you've created. And so we'll sort of look at the key areas to review in a portfolio and the key factors in the entire review process, how you set it up and go about reviewing your results. And then once you've reviewed your portfolio, maybe you've got some underperforming assets. Maybe you're out of sync with your target asset allocation. When should you rebalance your portfolio? How should you rebalance your portfolio? We'll take a look at that. We'll also see that you shouldn't just review and rebalance your portfolio. It's sort of a holistic 360-degree investment process. You actually have to look at your own life as well. Has my investor profile, has my financial situation, has my personal situation changed? Did I just get married in the last year? Did I just have a child? Did I just get sick and be out of work for 6 months. So every time that there's a material change in your life, you have to look in your investor profile and update that. And because your target asset allocation is defined from your investor profile, that too may need updating. So it's kind of this continuous process of reviewing your situation and your portfolio and modifying or rebalancing as necessary. So that's kind of the step 2 that we're going to look at. I doubt we'll need another 40 episodes, but there will be a fair bit of volume in what we cover, because for a lot of people, this is the meat and potatoes for them. And I still think the important part is the core concepts and understanding the process, but this is sort of what a lot of people want to hear, so we'll get into it. There we go. A look back and a look forward. Hopefully some of the stuff that we'll be getting into in the next weeks or months provides value to you, and I hope you've enjoyed the first half that we've covered to date. So thank you for your time, and I look forward to the path forward.